Welcome to IIT Stewart School of Business's presentation of Zebra Technologies Corporation. My name is Jason Strimple. This is Ben Hur, Lei Shai, Raghav Dubey, and Brian Rieger. We'll begin with our recommendation, followed by our investment thesis, as well as industry overview. We have a buy rating on Zebra. We're using two valuation models. The first is the discounted cash flow valuation model, which pegs Zebra at $47.55. This is a 17.8% upside from the April 5th close of $40.37. We also use a leveraged buyout valuation with a tender price of $51.12, which is a 26.6% upside from the April 5th close. We have four non-consensus ideas that we feel are not accurately priced into Zebra's current market price. Number one are cost-saving opportunities for manufacturers seeking to hedge against inflation risk. You'll see from the chart at the right, interest rates have been below the long-term mean for quite some time, and as they rise, costs will increase for manufacturers. Zebra's products are uniquely positioned to exploit these opportunities. Second, Zebra's return on invested capital is greater than the weighted average cost of capital, which creates wealth for investors, and if sustained, is a competitive advantage. We forecast that sustain. Finally, are technology trends that offer growth opportunities for Zebra. The prevalence of wireless internet connectivity within manufacturing facilities, as well as data, big data with real-time analytics. Again, Zebra's products are uniquely positioned to exploit these opportunities. Finally, we show a study from McKinsey Global Institute showing the broadening distribution of disposable income in emerging markets. Zebra operates in two industries, thermal printing and radio frequency identification, or RFID. RFID technology comes in two flavors, passive and active RFID. Passive RFID are tags that go onto products as they flow through the manufacturing process for tracking and inventory, or active, an example would be the Easy Pass module in your car for the toll booths here in New York. Thermal printing is in the late majority stage, whereas RFID is in the early adopter phase. This is where Zebra seeks to grow. 2010 sales, 91% of 2010 sales were made up of thermal printing for Zebra, where 9% were made up in RFID. Note these are 2010 sales figures for an approximation because Zebra no longer segments its revenue.
Zebra's business is characterized by penetration into vertical markets, unique product mix, and expansion in emerging markets. Zebra's products are robust and have applications in a variety of industries from aerospace to manufacturing. This versatility is a key quality in the continued profitability of Zebra's business. Zebra offers both hardware and services that are deeply integrated into its customers' day-to-day operations. Its thermal printing business, which is its main business, makes up a third of global market share. It is management's strategy to expand market share while they develop RFID solutions. Its RFID, which is a growing industry, makes up more than half of market share at the moment. Zebra's revenues more than doubled from 2000 to 2011. During this time, international sales increased a 20 percentage point of global market share. This is a key demonstration of the underlying strategy that management likes to execute.
Moving on to competitive positioning, which includes competitive proximity, DuPont analysis, and the overall competitive positioning score. We develop our own custom industry for Zebra because the likes of HP, Canon, these big companies, we are not considering them a true competitor for Zebra. They are too big. If they want to compete with Zebra, they are just going to buy it, which is part of our motivation to develop our LBO model. Financially healthy companies with similar market presence are worth investors' attention. As you can see at the right-hand side, we incorporate these two criteria to get our competitive proximity score. Intermec is the only public closest competitor with Zebra at a proximity score of 3.1. Finally, we went further with Intermec. As you can see from the top bubble chart, during the past 5 years, Zebra's ROE exceeds Intermec's ROE except for 2008, which is at the height of the economic recession. By looking at the components of the DuPont analysis, Zebra's strength is mainly from its high profitability. Finally, we conducted in-depth competitive positioning analysis As you can see, we arrived at a score of 71% for Zebra, which demonstrates its strong position in its market. The only challenge Zebra faces comes from its supplier power. Zebra relies on Jabil Circuit as its only supplier. We will talk about this risk later.
Moving on to financial analysis, where we will discuss Zebra's profitability, its cash flows, and its balance sheet. We expect Zebra to grow its top-line revenue at a rate of 5.5% compounded annually in the 2012 to 2016 forecasting period. This growth will mainly be driven by product expansion in emerging markets, as well as increasing sales from its RFID business segment. Zebra's margins are quite strong, which is a result of tightly managed product pricing. We expect these margins to continue to remain strong as Zebra completely outsources its thermal printing manufacturing to Jabil Circuit. This gives it access to lower prices in terms of both raw material as well as labor. Moving down to the bottom line, we expect Zebra's EPS to grow at a rate of 12.9% compounded annually. This is a result of expanding operating margins, which have grown 320 basis points to 18.7% in 2011. Zebra has bought a significant amount of its shares in the past 5 years and has authorized an additional 3 million share buyback. This will further boost its EPS. Moving to its cash flows, they're quite strong, which is evidenced by its 16.5% average operating cash flow to sales ratio. We expect their operating cash flows to increase at a rate of $4.4 million per year, which is a result of expanding margins as well as increasing top-line revenue. The quality of these cash flows is quite strong, and Zebra typically generates in excess of $100 million in free cash annually. This free cash flow can be used to finance organic or inorganic growth, as well as its share repurchase program. Finally, to its balance sheet, Zebra is a cash-rich company with no debt, which gives it strong liquidity and solvency ratios. Despite historically low interest rate environment, we do not expect management to lever up in our 5-year forecast. Zebra's capital requirements are low, and it retains $100 million in an untapped line of credit.
In valuing Zebra's business, we considered a number of valuation methods. We decided against the multiples analysis due to a lack of truly comparable public competitors, and against some of the parts DCF valuation, as Zebra does not report its independent segments going forward. In our discounted cash flow valuation, we have 2 stages. The analytic stage, during which revenue growth rate is assumed to be a 6-year arithmetic rolling mean. A perpetuity stage, during which, since the thermal printing business is a mature market, we believe that Zebra's revenues will grow at approximately the same rate as the GDP at 3% per annum. Despite these conservative growth estimates, we find value in Zebra in excess of its April 5th closing price. Zebra has maintained a zero debt capital structure, and assuming it does so going forward, the weighted average cost of capital is simply the cost of equity. Using a 20-year treasury yield, we get a weighted average cost of capital of 11.03%. Using this figure, we discount terminal value and future free cash flows generation and arrive at a value of $2.25 billion. The value to equity shareholders is $2.47 billion, and over 52 million shares, this gives us a fair value price of $47.55. Because weighted average cost of capital and growth rate are important assumptions in our valuation, we provide a sensitivity analysis stressing one against the other and devise a range between 44.92 and 50.53 around our valuation.
Moving on now to our leverage buyout model. Zebra is an excellent candidate to be taken private in the near future, due in part to its strong and consistent free cash flow generation, its zero debt balance sheet, and its position as a market leader in a niche market. Additionally, 2 of Zebra's main competitors have gone private in the last 5 years. Moving on to our model itself, we arrive upon a tender price of $51.12. We assume a standard 5-year exit strategy for investors and look to maximize IRR. This graph shows where IRR is maximized at 23.1%. At year 5, we also show enterprise value and net debt over time. It's important to note that with both our DCF analysis and our LBO model, we are assuming no significant changes to Zebra's capital structure. If there is such a change, this will significantly alter our forecasts.
We end with additional investment risks that we identified, including RFID industry adoption failure, the inability to protect their intellectual property, as well as supply chain disruptions. You'll see on our investment risk matrix, all 3 of these risks would have a major impact on Zebra's growth and cash flows. RFID industry adoption failure was identified as a likely occurrence due to its failure in the past. The inability to protect intellectual property, albeit a little bit less possible, is still a risk. However, Zebra has taken steps to mitigate these risks by actually being a founder of the RFID consortium and a participating member. Finally, supply chain disruptions. As we noted, 100% of the manufacturing of the thermal printing is done by Jabil Circuit. Any disruptions in this relationship may cause issues with the revenues. At this point, we'd like to take any questions that you might have.
Time.